Another nice good start to the day and finish for that matter, finish to the week. We had a nice good breakout pattern on the Nasdaq. So I'm going to break down the breakouts that we saw and what they mean. Are we ready to have the Qs lead us up for another good long year or two and maybe form a generational low point, which seems to be the buzzword of the day today? Or are we going to get a pretty significant fake out here with these breakouts? What are some signs that are suggesting that might be on the horizon as early as next week? So I'm going to break all that down with our trade idea of the day, taking advantage of what's leading and what's outperforming and taking advantage of the breakout and trying to get a good reward to risk ratio in case it persists. Let's go ahead and get started. Today is Friday, May the 8th, 2020. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 with the market forecast indicator. The nice little rally again today here and getting right up against that 62% retracement, the top of this resistance area. Of course, the retracement zone started when you get above the 23% level. And you get out of it to the other side when you break the 78% level. So we've still got some room to work. That's how wide that gap was. It'd be a much different story had we stopped. Had we stopped a little bit earlier, you can see. Let's say had we declined here, you can see we'd be right around the 50%. If you decline there, we would be popping up right now at that 50% mark. You can see, you kind of get the idea that the reason why we're so bullish now, this rally here, is because we dropped so much. I mean, shoot, if we were over here, we'd just be, if that was the end of the drop and we had just consolidated in here in this area and ended up here at 29.29, if this is the spot because remember this breakout here was on the oil spat between Saudi Arabia and Russia. Had that not occurred, there's a good chance that we might have just hung around, maybe dipped our toe a little bit, like say down to this level, to a lower low. And even then, we'd still be, kind of flirting with the 38% level of where we're at right now. So it kind of puts in perspective how strong the move has been simply as a function, getting all the way to the 62% level is a function of the fact that we had dropped so much. It wouldn't have been the case had we not dropped this much. And obviously this is, factoring in the same information that, that we would be factoring in back then. So going forward from here. So keep that in mind. This is kind of an important inflection point. We've been here before. We failed the first time. Let's see if we fail the second time or not. Or if this little head and shoulders pattern that we've got developing ends up playing out and we come back towards the lower end of this Fibonacci resistance zone that we have right here, or maybe even flirt back down to the bottom of the retracement zone, the full larger retracement zone there. The Nasdaq Composite looks a little different. So the composite is sitting right at the 78% Fibonacci. It has broken through the resistance. It broke through, retested, bounced back off of it, got to that 78%. The QQQ, which if you saw a tweet that I posted out there, 45% of QQQ, which is 100 stocks, 45% is five companies. Of course, Facebook, Apple, Amazon, Microsoft, and Google. All of those 5 companies there make up 45% of the Qs. The other 95 companies make up the other 55%. So, keep in mind that when you're looking at this stock, you're looking at essentially 5 stocks. And they did break through the 78% Fibonacci retracement zone. In fact, if you look at this great chart here that Clarence Carr put out earlier today and got to be the chart of the day on the chart report, it's a pretty awesome Twitter account to follow for technical analysts. But if you look at this chart, here is those 5 companies and how they performed, breaking up above their February highs as a collective group. The S&P 500, which remember this makes up nearly 21% of the S&P 500. So a fifth, 5 stocks make up a fifth of a 500 index. Some people say, I saw a tweet that said, 10% of the market's rally comes from 10% of the market's like moves over history have come from, or the majority of the market moves have come from 10% of the stocks. Everything else kind of matches, the treasury returns. The reality is that's not 10%, that's 1%. 1% of the S&P 500, and you can see the rest of the S&P is the orange line. If you take out, so this is all of them with the other 95%. Of the company, or the other, 99%. This is the other 99% of the S&P 500 that you don't see. And look at the decline. So again, this is from January the 26th. We started a decline on the S&P, and it was actually mostly, if you notice over here to the left, it was mostly these 5 companies. But then they rallied while the rest of the market didn't. And then you can see as they fall, the market rallies, and a little bit of an inverse relationship here between the two. But these 5 stocks have taken off all the way up, well up above these highs. This was a high point on January 26th. The S&P 500 is barely above those highs, about 3 percentage points above that January 26th high point. Even after the decline, we're back up just like that. The rest of the market, not so much. Really, really steep declines across the board. So, so the S, when you look at it from that perspective, this here is a good chunk of stocks that are breaking to all-time highs as a collective group. 5 of them, 5 companies, and driving a lot of this. And if you look at the next 5 companies, I think they make up about 10% of the Nasdaq 100. The next 5 biggest companies. After 45% from the top 5. So that would include Netflix and Nvidia, a couple other bigger companies. So it kind of gives you some context into really what's driving this action here. Strong, and this is a breakout. So we have broken out above the 78% level. If this holds and we continue and we hold this, there's a good chance that this brings the rest of the market up with it. On the other hand, you have the Russell 2000, which, remember the S&P is sitting at its 62%. The Russell 2000 is not. It had a really good return today, kind of reminiscent of a couple of weeks ago where the Russell 2000 had been lagging, and then all of a sudden, whammo, it took off in 3 days. But then that preceded a 2-day decline that pretty much wiped out all those gains, those outperforming gains that the Russell had. So. And this one's not getting quite as high. So we'll see if that ends up being, a very similar pattern here where the Russell 2000 makes a strong move right before a near-term decline. And then what will this near-term decline, will it just stay in near-term decline or turning in anything more? But you can see, it's not anywhere close to breaking above its 62% level, much less the 78% level that you're seeing that we would need to break through in order to continue this bullish trend to the upside. Otherwise, we just kind of have a wide range of up and down that as wide as it is because of how big this move is. This volatility created a wide range of space that we can trade in between. If you look at the Bollinger Bands, we talked about measuring that space. You can see the SPY came really darn close to breaking up above its band, still with that big point of control looming right above us, kind of acting as a magnet, drawing us up to it. The Russell 2000 did not break up above its band, not even touching it, but at least it's in the upper half of its range and trying to fill in this volume gap. QQQ, but well below its point of control. QQQ is actually well above its point of control and well above its value area, breaking up above this volume node and breaking up above its Bollinger Band, and for that matter, also breaking up above its Keltner channel. So that's a good sign that we have bounced and that we can now get going here to the upside. So a lot of good breakout signs that we would like to hold from the Qs, because if that holds, then there's a good chance that everything else gets pulled along up with it. The rest of the market kind of drags up along with the Qs, and we continue to ride this bullishness going forward. And we would see this gap here between IWM and the Qs, which has really gone parabolic here this year. We'd see that gap start to fill, right? If you break that 50-day moving, it's one thing to come back to the 50, but it's another thing to break above it and really get this long-term trend going, right? And that would mean the IWM, some strong outperformance in IWM. The problem is, in the past, it's usually been associated with relative, with risk aversion, not risk appetite. To see the Qs take off like this and then start to pull back. So a little bit of a concern there, but we'll keep our eyes on. I mean, that's very, very underperforming, strong underperformance from the small cap index. That either bodes very, very well for the small cap index, or does not bode very well for risk appetite in general. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video that will notify you when you click on those. That will notify you when our videos are posted. Also, hit that thumbs up icon that's down below the video. That tells us two things. Number one, you liked our video today. And number two, that you want us to do the video again Monday. Quick way to give us feedback. If you like our videos, let us know. With one click, you can do that right now. If you don't like our videos, you don't have to let us know. You don't have to click on anything. You don't even have to watch. All right. So, but we do appreciate those who do watch and who click that and who comment on our videos down below with anything that stands out to you. So love to see what questions or comments you have on what we talk about in the video, or anything we don't talk about but related to the topics, of course. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe. Follow me on Twitter for more content in between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, we invite you to check out the other things here that we have. Our classes to the right of the video. I actually have a Q&A session for our premium subscribers tomorrow morning, and then the rest of our class schedule posted here. You can see more by clicking on that link. Our monthly subscribers get access to all of our trading rooms and also our Market Outlook live trade review videos. So this is a highly popular product that a lot of people have asked for that we do. So again, monthly, all of our subscribers, our monthly and our premium, get access to that. So check that out there. We also invite you to engage with us on social media. Click this heart. It opens up this window. Like today's Market Outlook tweet. Click that thumbs up. Do the same thing on Facebook. Again, that benefits us because the more likes and engagements these posts have, the more likely Twitter and Facebook will promote our content to all of our followers. Same thing for that matter on LinkedIn as well. But it also benefits you too, because these platforms will promote content in your timelines from the accounts that you engage with. So we try to make it really easy for you to engage with us here. All right, now let's go ahead and take a look at the long-term chart from the S&P and take a look at this Hakinyashi candle. It's very, very important. There's a few things that we look for to see to gauge our bullishness, right? Number one is a higher high point. We didn't get that this week. We didn't get that week either. We did get a slightly higher high point, and the same thing occurred here. We got a slightly higher high point. The one small catch is we also got a lower shadow, and that's a little bit of a catch. Now, granted, we are at 29.29, which means that we're going to open up next week with a pretty decent, if you consider the midpoint of this body is right here at 28.39 roughly. We're going to have a pretty good size body to begin with next week, depending upon where we open. But we have a pretty decent chance if we open up around here on Monday morning, which hasn't been the case necessarily lately. We get so much movement overnight in these markets. But if we do start up here, or anywhere higher for that matter, then we can start next week with another good bullish body on the Hakinyashi. A good chance to get a higher high point because the high is 29.39, so we're only a couple points off of that high point. So a good chance to get up above the 200-day moving average next week, and also a good chance to avoid a lower shadow. And obviously have a much higher close next week. So we have the opportunity based on how we close this week to really finish and to kind of restart a new bullish move. Kind of a little, a couple weeks here this week, and then this week of a little sideways action. But then breakout, we can get a good breakout above the 62% level and really get going to the upside. You can see QQQ, sorry. You can see the move that it's making, again, breaking above the 78% level, a higher close, higher high, no lower shadow, above a rising 50-day moving average, which is pulling away from the 200-day moving average. I mean that's people will say that we've been in the bear market, but the reality is we had less of a death cross here than we did back in late 18-19. We had about as much of a death cross here as we had during that pullback in May. So this is not a bear market, right? It was a steep decline, but it was not a bear market. So that's the concern, right? If that kind of decline, that fast of a decline, cannot produce, even something like this, where it takes some time to really turn around and provide a better base for a good long-term move. If that can't produce that, then what kind of economic environment and earnings environment is going to produce this scenario, right? Either this scenario or this one, right? Going into 99, we were very similar, very highly concentrated within a few tech companies. QQQ was killing it versus IWM. Lots of similar scenarios. Cape ratios pretty darn high, in the mid 30s and going up into the 40s, at that time, and then we led into a multiple year decline. That's a bear market, and for that matter, so was that. But again, that kind of move, puts the 08-09 bear market, and at least from QQQ's perspective, and it makes it look really, really small, like it didn't even really exist, right? And then there's your credit crisis, there's your 15-16 slowdown, and then there's the end of 18, the Q4 of 2018. So you can kind of see, but what kind of environment is going to cause something like this to occur if a 30% decline in 4 weeks doesn't, right? So that's the issue that we have facing ourselves. It doesn't mean that we can't be bullish, right? Because if you're gonna think, oh no, this market could really tank and I'm gonna not buy any stocks, then who knows, right? We can be bullish for who knows how long. And there's that expression, the market can stay irrational, which might be irrational to us, might not be irrational to it. Right? The people involved, trading most of the money, they might not necessarily be irrational. It might be only irrational to us because it's not doing what we think it might be doing, right? But there's that concept of, the markets can stay irrational longer than you can stay solvent. So as long as it's bullish, we can ride the bullishness, especially in these particular stocks. But we do have to know that something like this is on the horizon. Whether it's in the next year, most probably not, but whether it's in the next 5 to 10 years, most likely. According to current valuation levels, very likely that something like this is happening. And this little pullback, and the fact that it doesn't produce any kind of bear market at all, not even a small one, a very, very small one like these two that we've had, raises a little bit of a red flag there about what we might have ahead of us, right? What could actually produce something like that. That's a little bit of a concern. Let's take a look at the 3 green arrow charts. Not enough of a concern though not to be bullish right now though, of course. Just make sure that we manage our risk really well and stay light and nimble in case, because you saw 4 weeks we were down a third of percent. The market lost a third of its value, so it can happen really, really fast. I doubt any time in the short term we'll get that kind of a drop again. Of course, it's very, very related to a singular event, and this coronavirus. If we do fall anymore, it's going to be because of economic slowdowns, because people just aren't, demand is down. Businesses might open up, but if consumers don't buy, then demand is down, and that's a lot slower bleed than a big cut like this is. You can see from a 3 green arrow standpoint, we're almost back to 3 green arrows. If you look at the crossovers, we're back above the 8-day moving average. All 3 lines are rising. The MACD is close to crossing back up above its moving average. Here, let's get rid of that line now. It's close to crossing back up above, which kind of shows you again the kind of the bullishness of the market, because we don't get this kind of move in the bear market. So we go up, we come back down, as we talked about before. You can see the stochastics never did dip below 50, and it's turning back up above its moving average as well. So a little bit of a turnaround in both those indexes. Let's take a quick look at some of these other oscillators. RSI and CCI, the key level here is getting above 60. We're dang close on the S&P. We have broken up above it on the QQQs. So that's a really nice sign. And then if you look at IWM, it's making another run to try to get above 100 and get above 60 on the RSI. You look at the DMI, and we'll look at it for the Qs. You can see really darn, the negative index is below 20, great. Almost back up above 30, so really, really good sign for the Qs. From a broader market perspective, we're almost getting there too. The S&P's almost above 30, and then you can see IWM has jumped up back up above 30, but its issue is its negative index hasn't crossed back below 20 yet. So not quite, closer on the Qs than any of the others, but not quite there. And then of course, from an Ichimoku cloud perspective, from a trend strength perspective, we're still in this zone where we look bullish, but not quite as bullish as we want to be when we get above 5. We are, however, easily above that number on the trends, both the trend strength as well as the trend noise balance, easily above 80, above 5. So looking very good there. From a small cap perspective, we're above 2 and we're above 65, but just barely, and we're not above the cloud yet. So it kind of again shows, how not as bullish we are from a much broader sense. Very small market cap weightings, right? Again, most of the markets in the S&P, like 80% or so is in the S&P 500. But still, from a small business perspective, we're not things aren't as nice as they are from a mega cap business perspective. All right, now let's take a look at the intraday chart. And here's the key going into next week. So we've had 2 days in a row of strong gaps to the upside. But both these days are on declining volume. So it's not like these are like breakaway gaps. Not like we saw like in Twilio from Wednesday's Market Outlook video, or from other stocks that we can see. Even the stock we'll look at today for our trade idea. Those are common gaps. And like other common gaps, like this one and like the one before it, and like this one, the common gaps most of the time, there's another one, most of the time get filled. These two haven't yet. This one started and it got that far into the gap where the green line is, but it still has room to go. And for that matter, this common gap as well still hasn't been filled in. So next week is going to tell the tale, right? This breakout on the Qs that can lead everything up and drag everything up along with it, which is the least likely scenario because that's not normal. Normally, when there's such a wide divergence in performance between Qs and IWM, it usually corrects itself with a move to the downside in both. But if the scenario, if the lower probability scenario plays out where these mega caps pull up everything along with it, then that next week we won't see these get filled in, these gaps. Even though they're common gaps, nothing's 100%, but you want to really avoid these getting filled in because you want this breakout on the Qs to hold, because if it turns into a fake out, that's more bearish, right? That we don't want a fake out. We don't want this resistance on SPY at the 62% Fibonacci level to hold. If you're bullish, we want it to break through and just get going and continue to trend. Continue this idea of the stocks will never, and that's the other unfortunate part about our markets right now is our markets have turned into a binary mode where you either go up all the time or you don't, right? You go down all the time. We don't have the nice normal cyclical breathing pattern of up and down, and inhale and exhale, and inhale and exhale of impulse moves and profit taking, and new impulse moves and profit taking. That give you better prices and better valuations. So that's the norm. We've kind of gotten out of that now. Now we either fall off a cliff to the tune of like third biggest drop in 23 days ever, or we bounce off of that low point with one of the fastest gains that we've had ever. The market's really kind of gone, and it's not unique, because if you recall, the 4 months heading into February, we were going up every day, even with coronavirus in China and divergences showing up, and us pulling out risk in January and February of this year. Not being bearish, but not being nearly as bullish. But we were just going up every day. Well, so it's not new to this big drop and rally. But if we fill in these gaps here early next week, which means that's a pretty decent move to the downside just to get to that level, much less, finishing to fill in, much less getting down into here, right? If we fill in that gap, then it's really going to be on. But even just coming down to 285, basically down to this volume node, the midpoint of the range, if we pull down into this node, that's a pretty significant, it's a 10-point drop. That's about it's not quite 10, 10% would be a 30-point drop. So a third of about 3-4% drop, depending upon how fast that happens, that won't be comfortable. And if we fill all the way down here, about a 20-point drop, then we're looking at, more than a 5% move, 5, 6, 7 in that area. So, but it would be very uncomfortable and would play out this head and shoulders pattern, and who knows how much further, that we could go down. Of course, you talked about in the past the best case scenarios and worst case scenarios, and I think our best case scenario is that we would kind of stop in that area. We still got that gap that we can fill in. That would be our worst case scenario if we were to continue to be more and more bearish from there. So those two gaps that we started off here yesterday and today, very, very important gaps to watch heading into next week. And if we can't hold those early on, and we end up with more of a bearish Hakunashi candle, and we turn out these breakouts on the Qs turn out to be fake outs, then that could lead to the weakness. Otherwise, if that breakout holds and then everything else breaks out along with it and eventually gets pulled up along with it, then we have some good opportunities here going forward. As we saw, when the Qs catch up, when the IWM catches up to where the rest of the performance should be, it can move very quickly and very rapidly, as we saw right here and a few of these other quick big moves that it made to catch up to where all the other indexes were already moving. Finally, let's take a look at the VIX. Well, first of all, really quickly, the range and the volume. Again, most of the range was overnight, so we had a very small range during the day today, but you have to account, the ATR accounts for that overnight trading. So 287.68 to 289.80, so another couple of points, so a little bit over 5 points, a little over half of the normal ATR, and then the volume still at 76 million, just really dropping off a cliff there. Another significant breakout that we had on this is a break below the 3% mark. So we got down to the 3% mark. If this breakout holds, then this is going to be the low point right here, right? If that's the thrust of selling, then the low point occurs after we hit 3%. Well, this is going to end up being the low point, all right? That we break out, that we break through 300. Because again, remember that point of control at 300 on SPY, we'd have to break through that 300 to really get going on it, like QQQ already has well done, breaking out of its value area. So, if this continues lower and we continue grinding, great. Otherwise, if we get a bounce up, which we've seen plenty of examples of that in the past, then, again, best case, worst case scenarios of where we can fall down to based on where those opening gaps still are that we haven't filled in yet. Finally, let's take a look at the Volatility Index. Big drop on the VIX. And here's another one of those things. We're breaking below 90%. And that's significant because that either means we're breaking below 90% like we did here and we just start a bullish move. And we just get going. And we use 90% as a resistance a few times, but we stay below it and we get going on a bullish trend to the upside. Or we break down below it like we did over here, and then we just take off in volatility from there. Now I don't think we'd take off all the way up here, but again, getting up to 105%, if not a little bit more, would coincide with that intermediate line pulling down back below 50 again. So, it's kind of a, it's like a fake out, breakout type scenario. If we break out and it holds, great. If we don't, then we've seen what happens when a breakout doesn't hold, and we just take it right back off to the upside in volatility. Again, that would probably mean like into the 40s. We're not going to be looking for it to get above 80 anytime soon. So you look back over here and you see the similar fake outs that were on the 95% mark, and not necessarily the 90% mark, but the 95% mark that led to the rise in volatilities in both instances here. So that's what a fake out can do, right? And then finally another one right there. And then here's a fake out below 90% that preceded that, right? Dip below 90 after being above it, dip below 90, and then took right back off again. So that's kind of what we want to keep our eyes on to see if that potential or possibility is there again for a fake out type move in volatility. All right, to summarize the technical outlook, we're at this inflection point where we've got to break out in a small area in the markets that could lead us up, that could bring everything else up with it, or we were at some resistance levels, and the possibility of gap fillings and a fake out as early next week could signal more weakness, the space filling weakness, not like new trend to the downside, but just space filling weakness in the short term, in the next week or two. So pretty important inflection point on either side. We can really go one direction or the other, and if you expect gaps to fill, especially common gaps to fill with light volume, then that suggests that these openings that we've had yesterday and today might bring those cues down a little bit down with everything else, especially with the outperformance that we've seen in some of these areas I'll talk about here in a minute, that we've seen before that preceded near-term weakness lately. So what do you think? Do you agree with that assessment? Do you disagree? There's a link popping out right there on the top right corner of your screen. Click on that link. It opens up a poll. Hit either agree or disagree. If you click disagree, comment down below as to why. What are you seeing that suggests either you're a lot more bullish than I am, you're really buying this breakout and away we go, or you're a lot more bearish than I am, that we're going to get more than just space filling weakness. So what do you think? All right, let's go ahead now then and take a look at the at what's driving this price action. And really important consideration that we saw here today, it really stands out. And let's take a look here. Let me pull up the asset class comparison chart. But today, for the first time in a while, we had in here, let's just go just to today. So we'll go to May 8th, and then we'll just go just today's chart alone. For the first time in a while, small cap stocks way outperformed the S&P 500. International stocks, for that matter, also a little bit of a drift late by EFA, but EEM outpacing SPY as well. Gold and bonds were down, and then value stocks. You don't see that here, but value stocks outpaced growth stocks today. When you take a look at this chart here, you can see how growth or value has been really falling all year long. Like, value is actually doing pretty well against growth until the beginning of the year, and then it really kind of fell off a cliff. A little bit of a bounce there, but really just fell off a cliff and has been continuing to get even lower. Like the gap between the 50 and the 200-day moving averages is considerably lower, like about as low as we've seen. If I were to go back to other areas, far back as we can with these two ETFs, you can see that this PPO is pretty darn low compared to even the 2009 low point. So, and you want value. See, you want value to lift yourself off of that level. But as you can see in the middle of the year, you can also get value to lift itself off in a downward trend, like during some periods of weakness where they both come down, the growth stocks come down more. So that's the issue, and that's the concern is, are we in this environment where value is going to lead growth on the way down, like hold up better on the way down, or are we in this scenario where value is going to lead growth off of a major low point? Well, the problem is we've already come off a major low point, and value has not been, the growth as value has been dropping like a rock compared to growth. So, you know, the next rally we're going to get, you know, we already are off the major low point. Are we going to get the kind of rally, you know, midstream that kind of starts this bearish run? So, you know, again, a little bit of a red flag that, but at least today, for one day at least, we had the nice little rally in the areas that we want to rally off of lows, even though we've already come off of those lows, right? If I were to go all the way back to, excuse me, let's stay here. Let's go switch this chart all the way back to March the 24th, where we came off of that low point there. You can see, you know, for the most part, SPY had been outpacing, and we had that late push there on IWM that pushed us up higher, but then it fell, and the SPY continued to outpace until today. And so that's, you know, there's our rally off of that significant low point. And you can see other indexes, I mean, bonds finally went negative after that, you know, after being positive that whole time. Bonds finally went negative here. Crude oil remains pretty negative. If I were to go over to the actual crude oil futures contract here, the continuous contract, you can see, you know, from the March 23rd low point where stocks hit, you know, we're just up just a smidgen off of that low point, and stocks, you recall, are well off of that. So of course it had its issues here, but you can see that's been corrected, and we still haven't really broken out of this sideways base that crude oil has been forming here, though it is good. Like we talked about, getting up above this moving average, light green shading yellow line, and holding that break. So far so good in that environment. Same thing we wanted to see in TNX. We wanted to see it form light green shading, yellow line, but then hold up above. Well, the last time we did this video, it didn't hold. Yesterday it dropped back down. Today we'll see what happens on Monday, right? If we can't hold this, then you can see again from a risk appetite standpoint, we're not getting the follow through in other asset classes that we want to see. And like I said the last time, you know, we had the strong run in value and in small cap stocks. It actually preceded some near-term weakness. The question is, what's the next near-term weakness going to be, right? This is the last near-term weakness. You know, we had that run on small caps and value and international stocks right there that got us up to that resistance. Well, we do it again. Last time it preceded that. What's the next one going to do? Are we going to break below, double top and break below that? That's the big question. Head and shoulders top, break down to 2650, fill in these gaps. That's the big question mark that we are looking to see over the next, really as soon as early next week. All right, from a sector standpoint, you can see the bullish sectors, right? The, you know, XLK, XLY, XLC, great. I mean, it's good for those to outperform. We want those to outperform. The issues we have are these two, right? These two should be coming up along with it, and they continue to have intermediate lines that are falling, showing light pink shading. Not surprising to see these falling. You know, they should be lagging. They shouldn't necessarily be falling. So they've got some light pink shadings too. It's all kind of concentrated in these large cap, mega caps, materials and energy, also trying to make a run. You can see healthcare, not as bullish as it has been, right? You can see from this high point that we had back here in mid-April, all of these back in mid-April, we're all kind of right around those lows, a little bit higher in materials, a little bit even more higher on energy, but way higher on these three, right? Discretionary not as much as communication services, and then especially here technology. They're all up to higher highs. Utility is down from that high, real estate's down from that high, staples is down from that high, and everything else is flat. So you kind of get an idea again of what's bringing the S&P up to slightly higher highs. It's all right here, really pretty much here, especially these two on the outside. All right, that brings us to our trade idea of the day. And again, like considering that we have plenty of negative deltas in our class portfolio that we teach in our classes at Market Scholars, it opens up the room to add some more bullish delta trades than we already have added. Even here in our market outlook category, the examples that we do here in these videos. Another one that we can add to our portfolio here is Uber. Uber is a stock that you wouldn't think would be doing as well as it is, but after its earnings, a really decent breakout the last couple of days, breaking up above to new highs, renewing its strong bullish posture, dark green shading, green line. If you look at it from a weekly perspective, you can see we are just starting to get dark green shading and a green line there on the weekly chart. For some odd reason, you can't see the lines down at the bottom, but the shading tells us what we need to see. We do have dark green shading and a green line again. So very good week for Uber. If you take a look at its long-term crossover chart here, you can see the earnings. We were kind of weak going in, but the nice rally got us up to a higher high and got us up above the 200-day moving average, right? If you look at it from this perspective. Nice close above last week's high and above the 200-day moving average there. If you look at its 3 green arrow chart, you can see we're above the 8-day moving average. It's rising, it's pulling away again. The MACD is moving up. The histogram is just turning up. Stochastic's pulling up above its moving average. A lot of these other oscillators are showing bullish patterns as well, back above 100 after already making the run above 260. Back above 100, back above 60. So far holding. You look at its DMI, you can see above 30, crossing below 20, or really close to crossing below 20 on the DMI. You look at its Bollinger Bands, and you can see, we had held on the pullback, we had held its point of control. We've broken through this area of volume. Now we've got pretty much a volume gap all the way up to this $40 level. So with that being said, we can say, okay, well, let's take a look at trading here. Let's go to the market outlook category, at buying the $36 call, and then we'll sell the 38, which is out of the money. So this is what it looks like here. We're going to buy the $36 call for June, but we're going to sell, considering it's short term, we're going to sell this $38 call and cap the gains. If it was, if we didn't want to cap gains, we go out to July or August. But since we are going to cap the gains, we can go out to June, kind of stay within that 50-day window there. Give myself, in this case, about 3/4 of my normal risk because I'm through the earnings. I've got a lot of good bullish signals. Remember, in $40 is where, where the volume, a new node of volume starts to kick in up here. So if we can get up and continue to trend higher up into that area, great, right? We get a good return, about 3-to-1 return for the risks that we're taking, with a really good chance of getting out at half of that risk, right? Remember, there's good volume support down here as well from the actual point of control. All right, and that's our trade idea for the day in our video for today. Again, you've heard from me. I want to hear from you now. Use that link popping out in the top right corner of your screen. That will take you to our Market Outlook forums at marketscholars.com. You can be able to post and answer, post any questions or comments you have. Keep this conversation going over the weekend here. Reply to other people's threads as well. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on our video down below. Follow me on Twitter for more content in between videos. Join our Market Outlook community on Facebook that we've created, as well as our website, our community on our website at marketscholars.com. Have a great rest of your weekend, everybody, and we'll see you all on Monday.